Welcome to the CoreLogic RP Data update on housing market conditions for March 2015. Last month we saw mortgage rates cut by a further 25 basis points, taking the average discounted variable mortgage rate down to 5.7%, which is the lowest mortgage rate since 1968. This was the first cut to the cash rate since August 2013, but the 8th cut since the Reserve Bank started easing the interest rates back in late 2011. On the back of lower interest rates, we saw auction clearance rates surge to their highest level since 2009. Sydney has seen auction clearance rates at 80% or higher over each week of February, while Melbourne clearance rates have been at 75% or over the second half of the month. Additionally, we saw the level of industry activity surge to new record levels across the CoreLogic platforms. Valuation events surpassed their previous record high in February, and the number of real estate agent pre-listing reports also hit new highs across every state and territory except for Canberra. Dwelling values also moved higher over the month, with our combined capital city index increasing by 0.3% in February, taking dwelling values 1.6% higher over the first 2 months of the year. The recently stronger housing market conditions have also pushed the rolling annual rate of growth higher after the annual rate of growth had been moderating over the second half of 2014. Capital city dwelling values are now 8.3% higher over the 12 months ending February 2015. Australia's largest city, Sydney, is still leading the market, with dwelling values moving a solid 1.4% higher over the month and 13.7% higher over the past 12 months. Melbourne remains the second strongest capital city housing market, with dwelling values 7.4% higher over the year, followed by Brisbane, where values have moved 5.9% higher. The weakest performing capital city is now Perth, where values have moved to 0.6% higher over the past 12 months, while Canberra, Darwin and Hobart have also recorded annual rate of growth that's less than 2%. With the pace of growth in dwelling values remaining substantially higher than growth in weekly rents, rental yields are continuing to reduce. A year ago, the gross rental yield for a capital city dwelling was averaging 4.3%. By the end of February, the typical gross yield had eroded to just 3.7%. Over the current growth cycle to date, we've seen capital city dwelling values rising at more than 3 times the pace of weekly rents. The byproduct of such strong capital gains and relatively weak rental growth is that rental yields are being forced lower and lower. The lowest rental yields can still be found in Melbourne, where the typical house is showing a gross yield of just 3.2%. However, with values growing quickly in Sydney, it might not be long before Sydney takes over the mantle from Melbourne as the lowest yielding city. Looking across each of the capital cities, we're still seeing a great deal of variance in the performance of housing markets. Sydney's housing market is setting new records across a variety of indicators. Dwelling values have increased by nearly 60% since the beginning of 2009, and they're up 13.7% over the past 12 months, while auction clearance rates set new record highs in February, reaching 86% over the third week of the month. Houses continue to show a stronger capital gain than apartments, with house values up 14.7% over the past 12 months, compared with unit values which have moved 9.5% higher. Investors have become the dominant sector driving housing demand in the Sydney market. Across New South Wales, investors now comprise 59% of all new mortgage originations, and the value of investment loans in New South Wales has increased by 34.1% over the 2014 calendar year. The rate of capital gain levelled in Melbourne during February, up 0.2% after recording substantial gains in December and January. Over the past 3 months, Melbourne values have moved 4.5% higher, which, despite the relatively flat reading in February, is the highest gain of any capital city over the past 3 months. Most of the capital gains are evident across Melbourne's detached housing market, where values have grown by 8% over the past 12 months, compared with a much lower 2.8% gain across the apartment market. Investor demand isn't quite as high as what is being recorded across New South Wales. Based on housing finance commitments excluding refinanced loans, investors were equally balanced, with owner-occupiers at 50.2% of the market. Brisbane's housing market conditions continue to languish compared with the performance of the Sydney and Melbourne markets, with dwelling values slipping 0.8% lower in February. Despite the low month-on-month reading, Brisbane remains the third best performing capital city on an annual basis, with dwelling values up 5.9% over the year. Thanks to the higher rental yields in Brisbane, the total return across Brisbane, which includes both capital gains and gross rental yields, is not much different to Melbourne's. Over the past year, the total return in Brisbane was recorded at 10.9% compared to Melbourne's total return of 11.4%. Houses are far outperforming apartments in Brisbane, with house values 6.5% higher over the past year, compared with a 0.5% gain in apartment values. Adelaide dwelling values are increasing at a pace that's only slightly higher than inflation. Over the 12 months to the end of February, Adelaide dwelling values were 3.4% higher, and over the past rolling quarter, values had increased by a relatively flat 0.8%. Similar to most other capital cities, house values are increasing at a faster rate than unit values. Over the year, house values have increased by 3.6% compared with a 1.7% gain in unit values. Rental yields in Adelaide remain higher than the national average, with a typical house providing a 4.2% gross yield and a typical apartment showing a gross yield of 4.8%. The Perth housing market has continued to soften, recording a 0.9% fall in dwelling values over the 3 months ending February. The capital of Western Australia has seen dwelling values rise by just 0.6% over the past 12 months, which is the lowest rate of growth across the capital cities. House values have been more resilient than unit values, with Perth house values rising by 0.7% over the past year, compared with a 1.9% fall in unit values. Weekly house rents have tapered to 4.1% over the past 12 months, which has dragged the local rental yield to reach an average of 4.1% gross for houses and 4.7% gross for apartments. Dwelling values fell by 0.9% across Hobart in February after showing solid capital gains over the previous 3 months. The trend remains positive in Hobart, with dwelling values 3.3% higher over the past 3 months and 0.7% higher over the past year. Over the longer term, Hobart's housing market has been the weakest of any capital city post-GFC, with dwelling values remaining 0.7% lower than what they were at the end of 2008. The positive trajectory in dwelling value growth is a positive turn of events for the Hobart market, which is now showing rental yields and affordability levels that are much higher than most other capital cities. The northernmost capital city, Darwin, recorded a 0.9% increase in dwelling values over the month of February. However, values remain 1% lower over the rolling quarter and have increased by only 1.6% over the past 12 months. Rents were down about 2% across Darwin's house and unit market over the past year. However, rental yields remain the highest of any capital city, with houses providing an average gross yield of 5.9% and units returning a gross yield of 5.8%. There have been 3,290 dwelling sales across Darwin over the past 12 months, equating to just 1% of all sales across the combined capital cities. Canberra saw a return of growth conditions over the first 2 months of the year after dwelling values fell over the final 4 months of 2014. Conditions appear to remain soft across the nation's capital though, with the number of homes advertised for sale 16% higher than a year ago. Weekly house rents are down by 3.6% over the year, and transaction numbers are nearly 8% lower compared with the same period a year ago. Looking forward, the big question is to what extent will lower interest rates affect the housing market? The previous rate cuts saw auction clearance rates surge back to the highest level since 2009, and industry activity across CoreLogic RP Data valuation and real estate agent platforms has now moved to new record highs. Based on what appears to be an enthusiastic response from home buyers to last month's rate cut, it appears that home buyer demand has been re-energised by the lower cost of debt, despite the headwinds of weaker labour markets and softer economic growth. With mortgage rates potentially moving even lower over the year, it stands to reason that home values will continue to move higher to new historic highs. The Reserve Bank has previously stated that they will be looking towards the regulatory framework to minimise risk in the housing market, and it's clear that APRA are vigilant for any deterioration in lending standards across Australia's lenders. The buoyant housing market conditions should continue to support growth in housing construction, which in turn provides a strong multiplier effect on the Australian economy, with increased housing activity flowing through to more spending on items such as building materials, appliances, home furnishings and white goods. Once again, thanks for tuning into the CoreLogic RP Data Housing Market Update. We're constantly updating our blog and website with fresh housing market research. To find the latest updates, you can visit www.corelogic.com.au.